Welcome to the show. Today, I believe, is a significant day for investors for three reasons: oil, interest rates, and believe it or not, artificial intelligence. We're going to get into it. Let's roll a quick intro, and I've got a really good show for you today. So please stick around while you're watching. If you have any questions, you want to ask me anything financial related or anything really, hit me up in the comments. If you don't mind, give us a like, a heart, a wow, whatever reaction is available to you in whatever platform you're watching. It helps spread the word of the good show, the good work we're doing here. Here's the intro. We're going to do this real fast. Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money, about helping you to take control of your finance. I start this today with the big headline news, attention grabbing headline. Big day today. Okay. Today was a significant day for three reasons. And those three reasons are as such. And I'll point them out first by going over today's price action. Today, the Dow is down 570 points. That's a pretty nice sized day. It's over 1% drop. Not quite a 2% drop, though, if you see that, all right? I like to say that a 1% or more drop in a day on a major average gets my attention, but 2% really gets my attention. But no big shakes. We've had many 1.5% moves in either way in the markets, the major averages. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. The Dow down 570, continuing some of the big down days we had in the last couple of weeks. April ends today. It's the worst month we've had on the Dow, at least I think in about a year and a half. But considering where we've come from in the last 6 months, no one could really complain. All right, we'll see where we go from here. Now, the NASDAQ was down a little over 2%, definitely attention grabbing. S&P down about 1.5%, but all the major averages were down a good amount. Gold giving back some of its, or I should say losing some luster. All right. I hope you're hearing these sound effects and I do them on the live stream. But one of the key reasons of why I say it's a big day for investors is oil. You see that oil down 1.3% down to $81 a barrel. So that brings me to oil stocks. And look at that. ExxonMobil down, AMLP, that's an ETF that tracks pipelines, down, Kinder Morgan down, Chevron was down over 3%. Just gets worse. Hess down over 3%. Conoco down. Murphy Oil down 4%. So that's the big number one. Okay. The first thing is this: oil stocks are down. Why is that significant at the moment? Well, it's not significant in the worst way. I think this is not the biggest. Let's say that in order of being, mild, medium, and hot. I'll call oil the mild one today. But the fact is, if oil is going down, and it never really, once Iran attacked Israel and Israel countered, I said right here in the show, that's it. Oil's done going up. And I've always said, I'm going to reiterate, all right, buying energy stocks or buying oil or gold due to geopolitical events is a very short-lived trade historically. They go up in anticipation of an event. The event happens, and it's basically buying the rumor, selling the news, and they go down. I was having this debate with a friend of mine, my good friend Lenny, one of my closest friends, saying oil has to go up now. Now it has to go up. Okay. Nothing has to do anything. But if your belief is so strong that something has to happen, you could be setting yourself up for failure. Nothing in the investments, stocks, commodities, interest rates, inflation, nothing has to go up or has to go down. You need to be more flexible in your thinking. You need to be more or less hedging or diversifying your opinions. Diversification is another word for compromise. I just have to say, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. But we say compromise, diversification, same meaning. So don't be so beholden to your thought that oil or a stock or something has to go up or has to go down. If the last 15, 20 years has taught us anything, lots of crazy things happened that are totally counter to what we believe would happen based on years and years of actions and reactions. And it just goes to show you very little is predictable. So let's be open-minded. What I want to say to you is that oil is going down. Why? Well, if inflation has been going up. April was the return of inflation and a new theme. So this is number 2. I'll tie it all together. This is the second reason why today was significant. We had wages come out a little stronger than expected. Now, non-farm payrolls comes out this Friday. That's going to be a big day. The Fed meeting, the Fed's having a 2-day meeting. The Fed meets 8 times a year. All right, so they meet today and tomorrow. People were thinking, would they cut rates in March or May? Well, now we're having the May meeting wrap up tomorrow. It's May 1st tomorrow. And now, we went from the Fed's going to cut rates a couple of times this year to there is no rush. So that's the theme of the market. There's no rush. So with inflation being stubborn, wages holding up, unemployment staying low, it's not really giving the Fed enough impetus to cut rates aggressively. Yet, rising inflation is causing a slowdown in the economy. You could see that, for example, in the news today from McDonald's, which came out and said lower income consumers are crushed. They just don't have the money for McDonald's. McDonald's has become a luxury. I mean, you know it yourself. You go to McDonald's, you can't spend $5. I mean, it's gotten to be expensive. It's like, McDonald's, it's no longer a low price restaurant, right? So that's what's happening there. But that's happening all over. And as a result, consumers might be paying higher prices for goods. So it might seem like, price stickiness or the prices that companies could get for their goods might seem strong. But the problem is unit volume starts to go down. We're seeing this in the automobile industry. We're seeing this with EVs. Volkswagen reported numbers, and they said their unit sales are starting to go down. In fact, Porsche, which is a high-end luxury brand, is down about 20% year over year. So maybe there are reasons for that. New models or electrification is taking longer than expected, whatever. But the point is, you could come up with an excuse for every company that says sales are a little down. You could excuse everything away. But when it's different companies in different sectors of the economy from different parts of the world saying that same thing over and over, you have to start to accept that things are getting weaker. Now, the Fed wanted to get things weaker. They wanted to put pressure on the goods part of the industry, of the economy. The service sector is booming. That continues to boom. I think we'll see that continue in Friday's non-farm payrolls. Travel, leisure, restaurants, alcohol, flying, that sort of thing. But this is having an effect on oil. So the geopolitical events have receded. It's generally accepted that Iran and Israel are not going to enter into a regional war, or at least not one that's out in the open. And all of a sudden, we're back to wondering, there's a lot of oil in the market. Markets are well supplied. And if the economy is getting weaker in China, Europe, and the US, it lets you know that demand for oil is going to go down. So even if OPEC and OPEC plus, that's OPEC plus Russia's OPEC plus, even if they continue to keep their thumb on production volumes, the demand component is deteriorating. So the fact that oil is coming down now might be good for inflation figures in the next couple of months, but it's not a good sign that the economy is maintaining its strength. That's why today's move is significant. The next move is that's significant is inflation. His wage numbers came out today pretty strong. But another one is artificial intelligence. If you recall, I mentioned artificial intelligence in the beginning of the show. So let's take a look at, I'll show you I call it my FANG M portfolio, but you might as well call it an artificial intelligence portfolio today. All right. Look at this. They're all down today. Well, the NASDAQ was down over 2%. And when you see that the big leaders of the NASDAQ were down across the board, you could see why the NASDAQ was down. But I want to point out something on Amazon. Amazon had a insanely strong earnings report. And as big as they are, they're still growing like a weed. And their advertising business is doing great too. Yet the stock was up about $5 or $6 when I started the show. I just looked, and now it's only up $1.37. The bang for the buck that companies are getting for earnings beats is much lower, if not existent at all. And that's because the stocks are already up so much. But the real deal for artificial intelligence is that investors are starting to realize the near-term and intermediate-term downside of artificial intelligence growth. What is that? It's the massive spending that companies like Meta and Amazon have to do. Even NVIDIA has to reinvest in their business. So it's a massive amount of spending. And when you take into account how much money companies have to spend to develop artificial intelligence, the components, the software to build up a user database, it's not going to be, it's not a free thing where it's just artificial intelligence. So now we're running up against high valuations because the stocks are up a lot. We're getting less bang for the buck for an earnings beat. I mean, if you take a look at Meta got crushed last week when they reported earnings. It's Facebook. You remember Facebook changed their corporate name to Meta. Meta had really strong growth, really strong earnings. The issue is they're spending a bloody fortune on artificial intelligence. But in another day and age, that stock would have been, I believe, up a lot, not down a lot. And the stock continues to deteriorate. So we're not getting real bounces out of these stocks, except for Tesla, which had a couple 2-day bounce. But now it's suspect if that bounce can even last. Google, which had a big pop yesterday after earnings, gave some back today as well. So we're starting to lose, we have already lost the momentum fight here as far as the large cap tech stocks go. Now, momentum could change at a moment's notice. So tomorrow they could be back. But I'm giving you the lay of the land of what these look like for the last 5 or 6 weeks. Momentum is clearly shifted. Subject to change, of course. So we have artificial intelligence spending, oil prices down, and lastly, we have interest rates that are up. And I've said this many times before, but the 10-year yield is up a little bit. But I want to show you, just bear with me. I'll just show you the whole yield curve, and I'll give you this in a nutshell. Okay. I'm going to my bond view for treasuries. I'm going to just make the screen a little bigger so you can see it. Stick with me, stick with me, stick with me. Here we go. Boom. I'll pop myself up in the corner here. This is the yield curve. The 2-year is above 5%. How many times have you heard me say, when the 2-year treasury yield goes above 5%, that's the demarcation line. That's the line. That's the line in the sand. Might as well be a line in quick, dry concrete that investors don't cross over. That's the line, the yield. Okay. That's the magic number for investors. That's when they say, well, for 5%, That's worth it to tie up money for 2 years as opposed to taking a shot on investing more in stocks. At 5% is tempting in a 2-year treasury. It's preservation because it's a treasury. You know, at maturity, you get your money back if you can hold on to it for the duration. You know that the 2-year treasury bond is typically low volatility, even in times of rising interest rates. And you know that for 5%, maybe I don't want to put more money into the stock market. Maybe I'll take some of my stock market winnings and lock up some of it in a 2-year treasury. Because, maybe I'll get 10% in the stock market, maybe 5%, maybe a little bit. But if the odds don't seem that great and the Fed's not cutting interest rates like we thought they would, maybe they don't cut rates for another 6 months or a year. And if the economy is slowing down and interest rates still remain high because inflation is stubborn, then we have to start wondering about stagflation. You know something? 5% in a 2-year becomes attractive enough for enough investors that money either stops going into the stock market or money comes out of the stock market. And it's, I think, a combination of both. So that's what's happening with treasuries. The 10-year is at 4.6%. Okay, if that goes to 5%, that becomes a pretty good deal too, especially if you're looking at the zero coupon bonds. So those are the three bugaboos, the three things that are affecting the stock market now. And those are a sea change. This is a big thing. Now that we're going into May tomorrow, you're going to start to hear, the sell in May and go away thing. It's a cute phrase, but what you have with the combination of the three factors that I just gave you, I think the weight on the stock market now is pretty big. It's a pretty big thing to overcome for investors. So that's my opinion, conjecture, whatever you want to call it. I thank you for watching. This doesn't mean that you take your long-term investment plans and abandon them, but it reminds you that money invested for the long term can stay invested for the long term. Money that is needed over the near term really shouldn't be invested in something volatile like the stock market, because if the market goes down right when you need your money, you might find yourself with a shortage of money because you just lost it in the stock market. All right, that's the show. I thank you so much for watching, and I will be back tomorrow. We'll see how May gets started. Thank you.